Assalamu alaikum and good afternoon, everybody. In this lecture, we are going to estimate free cash flow and weighted average cost of the capital to estimate the value of the firm. Okay, let's start with the free cash flow estimation first. Here, we are given with certain data. For example, we are given with the revenue figures for last 3 years. This is the actual data from the financial of the company. A stands for the actual data and P is the projected value, or the estimated value, the forecasted value, or the predicted value. Okay, so we are at this date. Today, the date is 1st January 2026. The company has closed their last financial year, and now the company is planning, the company is estimating what will be their future expected cash flow for upcoming years, for 5 years. Okay, how we are going to estimate the revenue? To estimate revenue, we need the actual data and we need a growth rate. Now, the growth rate calculation itself is a very difficult method, difficult to calculate the growth rate for the company. Uh, how you can estimate the growth rate of a company? You have to conduct macro and micro environment analysis. Macro and micro environment analysis. Now, what does it mean by a macro and micro environment analysis? I believe you are familiar with the PESTEL and Porter 5 forces model, and some other analysis can also be complementary use. Okay, to conduct a macro analysis, it's a broader analysis. You may use, there are other tools as well, but this is one of them. You can use the PESTEL, political, economic, social, technological, legal, and environmental analysis. Then there are a couple of options available to you to conduct a micro analysis as well. Okay, for example, I mentioned two of them only. There are other couple of options available as well. Then by um, going through all this macro and micro analysis, you have to estimate the value of growth rate in upcoming years. Okay, but for the simplicity, the growth rate are given already in this question. For example, the growth rate of revenue is 10% for 2026, 11% for 2027, 12% for 2028, so and so forth. Okay. Now, if the growth rate and the actual values are known, we can apply a very simple formula. Last year value, because we are going to apply the same formula for many of the figures. So I'm not writing last year revenue. Okay. Last year value multiply 1 plus growth rate. Okay, let's try. I believe you are familiar with the Excel calculation. To put any formula in Excel, you have to put the equal sign first. Last year value multiply 1 plus growth rate. Okay, by hitting enter, you will get the answer. Simply drag it to the right. Excel is smart enough. If you provide any sort of pattern to it, it will automatically copy the pattern for the next calculation. Okay, let's check if either the Excel is doing the right job. Okay, we can, by double clicking on this, we can simply see, it is evident that the Excel is following the right pattern. Excel is taking the last year value, right? Multiply 1 plus growth rate for the year. Okay, then we have to estimate the EBITDA. EBITDA is earning before interest, taxes, depreciation, and amortization. Again, we are given with the actual figures for last 3 years. And we are going to apply the same, not the same formula now, because we are given, it's not the growth rate of EBITDA, but it's a beta margin. When we are given with a beta margin, you are, I hope you are familiar that the margin represent, we are going to divide something with the revenue. Okay. For example, if you got gross margin, so it means you are dividing your gross revenue or the gross profit by uh, the sales or the revenue or the net income. So here, if we got the EBITDA margin, it means EBITDA margin equal to EBITDA divided by the revenue. And to estimate this value, we have to multiply revenue with EBITDA margin. So in that case, we are going to multiply revenue with the margin. Simply hit enter and drag it to the right. Excel will perform rest of the calculation. Okay, again, we are also given with the EBIT margin. Now, here it is important to clear. This is also known as operating profit. And it's before interest and taxes. It's not after taxes or after interest payments. Okay, here we are going to follow the same pattern, revenue, multiply the margin. Drag it to the right and done. Okay, then we are given with the depreciation as a percentage of revenue. Again, it's a margin or it's a ratio. Simply multiply the revenue value with the given percentage, and it will calculate the depreciation and amortization amount for you. Okay, once we are done with the income statement items, let's move to the balance sheet items now. For the balance sheet items, we are given with the cash and some other key line items. There are certain short-term assets. There are a couple of short-term liabilities and a long-term debt and long-term capital or capital asset. So if something is going to be constant, okay, let me clear one thing. If these values with the yellow background and the blue font size actually given in the question, these are the actual figures, and these are the projected one, that the debt is not going to be changed. The company's management decided they are not going to alter the capital structure anymore. So the value of debt will remain constant. And the management also believes that the cash holding is going to be same as of the last cash holding in 2025. Okay, then we are given with the growth rate of these items here. So we are going to apply the same formula. Last value multiply 1 plus growth rate. Okay, simply drag it to the right and drag it to the down. Excel is smart enough, as I told you, it will follow the pattern. It will follow the pattern. And if, for example, if you look at here, account receivable, and the next item is inventory. Here, we are given the account receivable growth rate, and the next we got inventory. So you can simply drag the formula to the down, and Excel is going to perform calculation for you. But if you further, if you try to further drag it down here, it will provide a wrong result. For example, if I simply click here, now what is the Excel is trying to do is taking this cell and multiply it with this cell. But what if there is no gap between these two rows, but here is a gap between these two values. There is an additional row. So if you simply drag the formula like this, and now you can check the Excel is taking this value and multiply with a wrong cell. So the distance or the pattern between the rows must be same, only then the Excel is going to provide the right result. Okay, understand? Okay, then we got the last item here, the same formula, multiply 1 plus growth rate. Simply drag it and it will calculate all of the answers. Okay. Okay, now let's move to the free cash flow calculation. In the to calculate free cash flow, we need operating profit after tax. So we have to convert this operating profit that was before interest and taxes. We have to eliminate the tax effect. We have to deduct the tax effect from this operating profit. Okay, let's try to fill this sheet, the available sheet. Do we got the total revenue for 2026? Yes, we have estimated here. So simply take the value from the calculation you performed earlier. Then we got EBITDA value. Yes, we have a EBITDA value here. Do we have EBIT value? Yes, we got EBIT value as well. Okay, now simply select and drag it to the right, and Excel is going to fill all the cells. Okay, now let's do the calculation. To calculate the operating profit after tax, you have to apply EBIT multiply 1 minus tax rate. Okay, EBIT multiply 1 minus tax rate. Okay, now what's the value of EBIT? The value of EBIT is given in cell F51, and the tax rate value is given in cell 52. Okay, hit enter and drag it to the right. It is going to calculate the answer for you. Okay, now as we are calculating the free cash flow, which means if you have paid something in cash or you have received something in cash, only then it is going to be included in the calculation. But here for depreciation, as you know, it's a non-cash item. So we are going to add back this. This non-cash item. Okay, let's take the value of depreciation. Okay, then we have to make adjustments. In the formula given in the slide, required investment in the operating capital. You have to look for the uses and sources of cash here. In this short-term and long-term, either short-term assets or short-term liability or the fixed capital. Okay, capital assets. So we have to look for the uses and sources of the cash for these short-term assets first. Okay, to look for these changes, we are going to apply a formula: last year value minus current year value. This formula is for all the assets, either it's long-term or short-term. So these are the assets that we are given in the balance sheet above. For all these 4 items, we are going to apply this same formula: last year minus current year value. And for the liability side, we are going to reverse the formula: current year minus last year. And these formula, the objective is either to see use or source of cash. Either something is a use of cash or there is a source of cash. Let's try with the account receivable first. Okay, this is the last year value of account receivable minus current year value. Hit enter and we got a negative 135 amount. Okay, simply drag it to the down and you got the value of inventories and prepaids. Okay, now reverse the formula for liabilities. Here, the current year value minus last year value. Hit enter. Okay, the last value is property, plant, and equipment. Now it's an asset, so we are going to apply last year value minus current year value. Once you are done with the calculation, simply drag it to the right and Excel will perform rest of the calculation. Okay, this is how, and once you are done, you have to apply, you have to add this sum. Okay, you have to add all these amounts, and this is your final answer on leverage free cash flows. Simply drag it to the right, and we have estimated the free cash flow that can be used here to estimate the value of the company. I'm not going into detail that the company is going to be operated in perpetuity. We will see that in later lectures. But for your understanding, this is how we are going to estimate the free cash flow for a company. In the capital budgeting chapter, we used the term free cash flow, and the formula was very simple: sales minus cost. So that is not a true estimation of the free cash flow. The true estimation of the free cash flow, you have to adjust the profitability, operating profitability after taxes with certain changes in the operating assets. And then after performing all these calculations, you are going to get the free cash flow. Okay, now let's move to the weighted average cost of capital. I hope the things are clear. There is no confusion. If there is confusion, you can ask a question in class, and I'm going to clarify the things for you. Okay, now let's move to the other part, that is the weighted average cost of capital. You are familiar that weighted average cost of capital is a combination of cost of equity and cost of debt. So in the cost of equity, there are two types of securities. One could be the preferred one, and the other one could be the common share. Okay, let's see an example and try to understand the concept of weighted average cost of capital with this example. Okay, here we got a company who got some certain outstanding number of shares, the common shares, and the amount is 350,000. The current market price is 6.2 ringgit. Historically, we are given certain historical data for the dividend. For last 5 years, the company has paid dividend to the shareholder. In the 2025, the shareholder received a dividend of 0.26 cents. And in 2024, the dividend was 24 cents, 23, 22 cents, 22, 20 cents, and 21, 18 cents. So we are given with a 5-year dividend data. Then the company's return on capital employed ratio is 14%, and the retention rate was 60%. There is an additional information given to us, that is Malaysia long-term economic growth rate, that is 4.5%. Okay, this information pertains to the common shares. Okay, now let's see what is given for the preferred shares. We are given with the outstanding number of shares, that is 70,000. And then we are given with the annual fixed dividend payment in perpetuity, that is, and the value is 1.1 ringgit. The current market price is 9.5 ringgit. Okay, if you want to buy one preferred share in this company, you can buy it at 9.5 ringgit. Okay, now we are given with the bond information regarding the bonds of the company. The total value of the bond outstanding is 900,000 ringgit. The maturity of bond is 10 years. Coupon rate is 6% paid annually. Then the market price. Currently, the bond is trading at 880 ringgit, and the face value of the same bond is 1,000, which means after 10 years, when you are going to redeem the bond, the company is going to pay you 1,000 ringgit. But you can buy the same bond Okay, and the corporate tax rate is 27%, and we have to calculate the weighted average cost of capital for this company. So let's start with the calculation. Let's see what is the formula for weighted average cost of capital first. The formula for weighted average cost of capital is weight of equity multiply cost of equity plus weight of preferred share multiply cost of preferred share plus weight of debt multiply cost of debt. Okay, how you are going to calculate the cost of equity, cost of preferred share, cost of debt, and weight of equity, weight of preferred share, weight of the debt? Let's see what options are available to us. To estimate the cost of equity, There are two options available. There are other options as well, but we are discussing these two options. First of all, we can use the dividend growth model, and the formula is P naught is equal to div naught. Div naught is the most recent dividend announced at the page, multiply 1 plus G divided RE, that is the cost of equity, minus G. Okay, now let's recheck what we are given in the question. We are given with the current market price, and we are given with the most recent dividend, G value. There are a couple of options available to estimate this G as well. But the most simplest one, you can use the company's economic growth rate as the value of G as well. But this is not the preferred choice. Okay. So if we look at the question data itself, we are given with the company's long-term economic growth, that is 4.5%. So this could be used as G, but again, this is not a preferable choice. But for the simplicity, you can we have the value of G as well, 4.5. Then do we have the value of cost of equity? We don't have the value of cost of equity. So this is the one we have to estimate using the simple math rule. I'm going to rearrange the formula, and the formula will become div naught multiply 1 plus G will be div the expected dividend in 2026 divided by the present value, market value, plus the growth rate. Okay, so this could be used to estimate the cost of equity. Okay, then there is another option available, that is the CAPM, or capitalistic pricing model of security market line. If we are given with the information such as risk-free rate of return, the return on treasury bills are considered risk-free rate of return, plus the beta of the stock. Beta is actually a measure of systematic risk. If we are given with the information of risk-free rate of return, beta, and market index return, then we can use this formula. But in this question, we are given with the information regarding the market prices, dividends, and growth rates. So this formula cannot be used in this case. So let me focus here on this formula. Let's see how we are going to estimate these things. Okay, these are the this is the information given to us in the question, and this is the formula that we are going to apply for the to estimate the cost of equity. Okay, if we use last year dividend, the last year announced dividend or the paid dividend was 0.26 multiply 1 plus growth rate. I'm using the figure long-term Malaysian economic growth rate as the value of G divided by the current market price, that was 6.2 ringgit, plus the G value. Okay, if I'm using these values, our cost of equity will be 8.88%. Okay, there is another way to calculate the value of G. You can also estimate the value of G if you are not given with the Malaysian economic growth rate. If we believe you are given only with the dividend history or the dividend data, and no Malaysian economic growth rate is given, then using this data, you can also estimate the value of G. Okay, how you can estimate the value of G using this data? You can apply you have to calculate annual growth rate first. To calculate the annual growth rate first, you have to choose current value divided by the last year value minus 1. Using this formula, you can estimate the annual growth rates. If you have calculated the annual growth rate, now simply apply the average. And this could be used as G in the calculation. This could be your growth rate for the question. This is one option that can be used. Instead of using the long-term Malaysian economic growth rate as the G value, you can simply take this value and average value. Average value is a good option if there is a significant fluctuation in the dividend payments. If the dividend payments are constant or there is a very little fluctuation, you can use the last year value as the G value as well. But using average is a quite better choice. Okay, then you can also use, this is arithmetic average. You can also use the geometric average as well. To apply the geometric average, you need to apply a formula. That is, okay, let me write the formula first. Last dividend, initial dividend, raised to power minus n r. You can use 1 by n minus 1. So this is the formula that can be used to estimate the geometric average. Okay, let's try with this formula. This is the last dividend. This is the initial dividend raised to power. Okay, I believe you are familiar. To have a raised to power, we need to put the cap 1 by n. N is number of year. So I'm writing manually minus 1. So we got a value of 7.63%. This could be used as G in this calculation as well. Okay. Then there is another option available, that is the multiplication of return on capital employed with the retention rate. You also got the value of growth rate. This growth rate can also be used as the value of G in this formula. So you are given a couple of options. There are other ways as well to calculate the G to have to be used in the dividend growth model. Okay, and be sure that if you are using this G value, your answer is not going to be this one. Your answer is going to be the different. Okay. Then what we have calculated the cost of equity. Now let's move to the cost of preferred share. As the data says, the dividend is fixed, and the maturity of the preferred share is in perpetuity. So it means the perpetuity formula can be used. The perpetuity formula is very simple, which states, okay, let me write the perpetuity formula. Current price it could be C or C payment. C stand for the cash flow, or the payment PMT, or you can use the div, whatever the term you can use. Okay, the current price of something that you are going to expect to receive or pay permanently forever. The formula is very simple. The payment or the cash flow divided by the discount rate. So we have to calculate the value of R using the simple math rule. I just replace the cost of preferred share with the current value. So the formula becomes dividend, that is the payment we are going to receive if we hold the preferred share. The amount is 1.1 ringgit and the current market price is 9.5 ringgit. So using this formula, we can estimate the cost of preferred share, that is 11.58%. Okay, now let's move to the third element, that is the cost of debt. To estimate the cost of debt, we are given with this information. What we have here, we got total value of bonds, we got coupon interest payment, we got market price, we got face value. Okay, So this formula could be used to estimate the cost of debt based on the information given to us. Okay, let's see what is the coupon rate. Coupon rate was 6% given in the question. What was the face value? Again, the face value is given in the question, 1000 plus face value minus par value. Par value is actually the market value. So face value was 1000 and the par value was 880 divided by time to maturity. So there is a 10-year time to maturity given in the question. Okay, this one, bond maturity, 10 year. Then we got divided face value plus par value divided by 2. So the face value again 1000, par value 880 divided by 2, multiply. This is actually yield to maturity. This is the formula of yield to maturity. If you hold the bond until the maturity date, if you are going to buy this bond today and you are going to hold the bond until the maturity date, how much you are going to get as a return from this bond. This is also known as yield to maturity. This is a pre-tax rate. The element from here until this point is actually the cost of debt before tax or before the tax shield. Now we have to multiply 1 minus tax is for to estimate the cost of debt after tax shield. Okay, so this element is actually the true cost of debt after incorporating the tax shield element. So what we have after the tax shield, the cost of debt is 5.59%. Okay, before applying this tax shield, the rate could be a slight higher. Okay, let's try. Let's see how much was that rate if we don't apply the tax shield. 6% multiply face value plus face value minus 880 divided maturity. Okay, whole divided 1000 plus 880 divided by 2. Okay, now I'm not multiplying 1 minus tax rate. So once I hit enter, the cost of debt, the value of RD before tax, before tax shield is actually 7.6%, the higher value. Okay, when you multiply this element, now your answer is 5.59%. That is less than this value. Okay, what you got? 5.5%. What is the difference? So you save 2.07% because of incorporating debt in your capital structure. Your tax liability is reduced. Okay, now let's move to the weight parts to estimate the weight of these securities. The market value, you need to calculate the market value of common share, preferred share, and the bond. Okay, how we are going to calculate or estimate the market value? It's very simple. Outstanding number of shares multiply current market price. For the common stock, do we have the number of outstanding share? Yes, we got here. Multiply. What is the market price? This is the market price. So you need to multiply number of outstanding share with the market price. You have to do the same with the preferred share. These are the number of outstanding share. Multiply price per share. For the bonds, you need to take the total bond value. What is the total bond value? the total bond value is this much divided by face value. This will report the total number of bonds issued or outstanding. Okay, so this is how you are going to calculate the outstanding bonds. Now multiply price, just the same way we did for the preferred and common share. Now this is the market price. Okay, now we got the market value of common stocks, preferred stock, and the bond. What you need to do, you simply add all of these. Okay, and there is a shortkey Alt plus sign. So it is going to sum up all the cells closer to the formula. So here we got the total capital of the company. To calculate weight, what you need to do, you need to divide the amount of common share divided by the total capital. As every amount is going to be divided by the capital, so I'm locking the cell. Simply drag it and Excel will calculate rest of the answers. Okay, now we got weights and let me write it here, cost. What was the cost for common share? It was 8.8%. For the preferred stock, it was 11.5%. And for the debt after tax, 5.59%. Okay, now we got the cost and the weights as well. So the next step is to multiply both of them. Okay, weight of equity multiply cost of equity. Do the same practice for preferred share and the common share. And the last step is to add all these three. Okay, this is our final answer, weighted average cost of capital. Okay, if you got any question, you can ask me in class. So I'm going to address the queries or concerns you are going to face during this calculation of free cash flow and weighted average cost of capital. I hope the video is very clear, but still, if you got any question, please do let me know in the next upcoming lecture. Thank you.